The Meta platform's Meta stock is currently trading at $599.08, reflecting an intraday loss of $2.92 or 0.49%. Now, the immediate expectation after seeing a dip like this, especially on a day when tech peers might be holding steady or even slightly up, is to attribute it to general market jitters or the usual profit-taking following a substantial rally. But the deeper, more unexpected reality is that this slight persistent pressure stems from the market grappling with a recent, massive, and necessary tax adjustment that, while non-cash for the most part, completely distorted their headline net income for the third quarter of 2025. When the company reported Q3 earnings, the top-line revenue growth was phenomenal, up 26% year-over-year to over $51 billion, driven by their family of apps. That alone should have sent the stock soaring, confirming the strength of the core advertising machine. However, the reported diluted earnings per share crashed by over 80% to just $1.05, a staggering drop that caused the stock to immediately slide by more than 11% in the after-hours trading period following the announcement. This dramatic plunge was the market's visceral reaction to the $15.93 billion one-time non-cash tax provision, a charge related to U.S. tax reform. Investors saw the headline EPS figure, panicked about an 83% drop in profit, and hit the sell button without fully absorbing the adjusted EPS figure of $7.25, which comfortably beat analyst expectations. This is where the tension between expectation and reality becomes critical for Meta stock. The market expected a clear-cut earnings beat with clean numbers, but the reality was a highly profitable core business obscured by a massive accounting charge and a significant escalation of future spending. The current modest intraday decline is simply the lingering psychological aftershock of that distortion, combined with a sober reassessment of the gargantuan capital expenditure forecasts. The current engine is accelerating. The common ground for most investors in Meta platforms is a simple, potent thesis. The company runs the dominant global advertising business built on four of the world's most used social and messaging platforms: Facebook, Instagram, WhatsApp, and Threads. This family of apps business generates mountains of cash with impressive operating margins, fueled by the relentless demand for digital advertising, especially as their AI-driven recommendation engines, which have led to a 5% increase in time spent on Facebook and over a 30% increase in video time on Instagram, become increasingly effective. Even with the recent volatility, the core advertising revenues in Q3 2025 were up over 25% year-over-year, and the average price per ad impression increased 10%, showing pricing power. User engagement continues to climb, with family daily active people reaching 3.54 billion, an increase of 7.6%. This is a staggering scale in engagement, which is why the stock has had such a meteoric rise from its prior lows. However, the deeper reality is that Meta is currently running two wildly different businesses with fundamentally opposed financial profiles, and the market narrative is currently fixated on the wrong one. The expectation is that the advertising business, the engine, is slowing down, while the reality is that the core business is accelerating, but its massive profitability is being strategically and deliberately redirected. The real challenge is the second business, the massive, all-consuming investment into artificial intelligence and their longer-term vision, which includes Reality Labs. Management's guidance for 2025 capital expenditures has been raised significantly, now expected to be between $70 and $72 billion, a sharp increase from previous years, with an explicit warning that 2026 capital expenditures will see notably larger dollar growth. This immense spending, mainly directed at building out the foundational AI infrastructure, data centers, high-end specialized chips from companies like NVIDIA stock, and top-tier engineering talent, is the primary headwind creating tension in the share price. The market looks at the cash being burned and fears a repeat of the ill-fated metaverse overbuild, where billions were poured into a future that failed to materialize quickly enough. Institutional sentiment and technical outlook. Institutional activity around Meta platform stock has been fascinating in the wake of the earnings report and the capital expenditure guidance. We saw a mixed but highly active picture in the last reported quarter, Q3 2025. While the number of institutional holders remains robust, there has been a net increase in institutional buyers over institutional sellers. Large asset managers, including Fidelity and Vanguard, still hold massive positions, though FMRL, Fidelity Investments' parent company, did trim its position slightly, reflecting a cautious move to lock in profits after the stock's massive run-up earlier in the year. The heavy selling action immediately after the Q3 report was largely technical and sentiment-driven, but the fundamental long-term money has largely maintained its positions, viewing the sell-off as a temporary hiccup caused by the accounting charge and an opportunity for accumulation. This institutional confidence is backed by the consensus among Wall Street analysts, who have a median price target significantly higher than the current price, with several maintaining strong buy or outperform ratings, citing the strength of the core ad business and the inevitable future returns from the AI investment. The market's perception of the Tesla stock story, where similar high capital expenditure and massive spending on future technology were initially punished before the market validated the long-term vision, offers a potential parallel that long-term investors in Meta are likely considering. The debate here is not about the profitability of the core business, but the timing and return on investment from the AI spending, a question that will determine whether Meta stock is a deep value opportunity or a long-term capital sink. The daily price action and technicals are currently in a corrective mode. Since the sharp drop following the earnings call, the stock has been attempting to find a stable base. High trading volumes around the initial sell-off indicated a significant transfer of shares from short-term traders to long-term investors. The stock is currently trading below its 50-day moving average, a level that technically minded investors view as a sign of intermediate-term weakness. However, it is holding above the critical support established by the pre-earnings consolidation area. Should the stock break convincingly below the 590 level, it could signal a deeper retracement towards the next major support around 550. Conversely, a sustained daily close back above 605 would suggest the bulls are regaining control and the market is ready to look past the spending fears. The broader sector momentum is mixed. While the general tech sector has seen some retracement due to higher interest rate fears and general macro pressures, the AI infrastructure players, particularly those connected to the large capital expenditure cycle, remain relatively strong, which provides a slight tailwind for Meta's narrative. For investors who manage their own portfolios, whether through platforms like Schwab Intelligent Portfolios or through an individual brokerage account on sites like Interactive Brokers, this environment of high volatility driven by conflicting signals is a pure test of conviction. You are essentially betting on management's ability to execute a multi-year, multi-billion-dollar infrastructure build-out. Now, let's talk about what the company does, which often gets glossed over in the noise of earnings calls and tax charges. Meta Platforms, Inc. is a global technology company best known for its social media and communication services. Its business is built on two primary segments. The first, and by far the most profitable, is the family of apps, which includes Facebook, Instagram, Messenger, and WhatsApp. The business model is simple. Attract and engage billions of users for free, collect vast amounts of proprietary data about their activities and interests, and then sell highly targeted advertising across the entire ecosystem. This is a formidable moat built on network effects and scale. The second segment, Reality Labs, is the long-term bet, encompassing hardware, software, and content related to virtual and augmented reality. While Reality Labs is currently a source of massive operating losses, reported at over $4.4 billion in Q3 2025, which, while substantial, was largely flat year over year, It represents the company's vision for the next generation of computing platforms. Past performance has shown that when the core advertising business is firing on all cylinders, as it did following the massive post-COVID digital ad boom, Meta's stock can generate outsized returns. However, the period between 2021 and 2022 demonstrated the fragility of the stock price when the market questioned the direction and cost of the RL investment. The recent surge has largely been due to a cost-cutting focus and a return to strength in the core ads business, an expectation that the current spending guidance now directly challenges. Outlook and regulatory risks. Looking ahead, the future outlook for Meta platforms is a complex calculation of short-term capital intensity versus long-term technological dominance.